Today's ECB decision was already the highlight event on the calendar before the week got going, but has attracted even more attention in light of the ramped up depreciation in the US dollar. The dollar weakness has been a major driver behind the euro's recovery run, but hasn't been the only contributor. Broad Eurozone fundamentals have also been supportive of the higher euro exchange rate, and this alone has given the ECB more to think about with respect to its policy normalization timeline. And yet, with the U.S. administration's soft dollar policy talk coming out from behind the scenes, jumping front and center in early 2018, as we saw most recently through yesterday's Mnuchin comments and this week's U.S. tariffs, there's an added pressure on the ECB to be thinking and making sure it doesn't send any messages that will work against its objectives. On the one hand, while the euro has been rallying of late, we aren't at levels that should alarm the ECB given the fact that the euro has traded at much higher levels. But on the other hand, the combination of the rapid, one-directional nature of the move and the politics behind the move, with the U.S. campaigning a soft dollar policy for the first time in a very long time, could be enough for Draghi to make an effort to combat this with a tone that leans more to the accommodative side. We're also not sure if Draghi will even want to make it seem like he is fixating on Mnuchin's comments, preferring to make it more about the Eurozone's recovery and the bigger picture. So we would caution against expectations for Draghi to come out swinging with an aggressive response to Mnuchin that comes off distressed and panicked. The expectations for the decision do afford the ECB flexibility this time round, with the market not really looking for any changes from the ECB until March. It would seem the ECB will look to take advantage of the time afforded, as central banks like to do, trying to maintain the outlook as is, offering a balanced assessment that acknowledges the economy moving in the right direction, but at the same time continues to proceed with caution, with subdued inflation still justifying a reserved approach. Overall, we shouldn't see any change to policy, and we should expect a balanced decision. At this point, in the aftermath of yesterday's dollar collapse, it would seem the built-up expectation for Draghi to issue some form of a modified outlook in response to Mnuchin that has the ECB upgrading its displeasure for the euro appreciation more than it already has expressed is an expectation that could very well be let down. If the market is relying heavily on this outcome, it could end up inspiring another euro run. Technically speaking, it's important to highlight the breakout beyond the 2017 high in 2018 has opened a measured move upside extension targeting 126.50. This level is a big level. It's a big one, as it also roughly coincides with falling trendline resistance off the record high from 2008. On a very short-term basis, there is some resistance up around 125, while a break back below 122.90 would be required at a very minimum to take the immediate pressure off the top side. That's all for now.